Welcome back to the Old Fashioned Real Estate Show. That's Brian Leverage, and I'm
Jeffrey Holst.
Oh, good job. You know who I am. I love it.
Yeah.
So we have a great show for you today. We're going to explain long-distance real estate investing.
Yes, we are.
It's kind of like long-distance relationship, only slightly different. And we're going to do it right after this.
The big difference being that long-distance investing can work. Yeah.
Well, fair enough. You know, we're going to dive more deep into that distinction right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
All right, so long distance real estate investing. Brian, why should you do it?
That's a great question, Jeff. But there's a lot of answers, and it would be too long of a show if we tried to delve into all of them. But I think maybe one of the most simplistic things is people have, generally, if they're using their own capital, a finite amount of that. In some markets, that capital is going to go a lot further than it will in others.
Sure.
Okay?
So maybe there's a better market.
Yeah.
That's what you're saying.
There's also a measure of risk, right? You know, a more expensive deal, if you've got limited funds, means all of your risk is in a single deal. Whereas if you're in a different market where things are cheaper and your cash goes further and you could buy hypothetically multiple deals, your risk is now spread across several, as opposed to being just in one.
So I think you're really referring to like people that are on the coast. You know, a single family house might be multiple $1 million, where you can buy something here in Chattanooga.
Well, somebody who lived on the coast and now lives in Chattanooga, Tennessee, yes, I can relate.
I would imagine. So would you say that the coast, like where you were from in Southern California, is a bad market for investing?
It's different. It is. Things are much more expensive. To give you just an example, right now, apartment buildings, a C-class apartment building here in our market in Chattanooga might cost anywhere from about $75,000 to maybe $85,000 or $90,000 a unit, plus renovations. But that's about where things are selling right now. In the same area as C property in Los Angeles County, someplace, is going to run you $300,000 to $350,000.
So 3 to 4 times as much money to buy a similar product.
And the rents are essentially double there where they are here.
Right.
We can get a $1,000 a month on the 2-bed here. Once it's fixed up, out there you're talking about $2,000 to maybe $2,200.
Okay, so basically what you're saying is there's some markets like Los Angeles where it might be double as much rent, but it might be 4 times as much cost.
Mm-hmm.
And so the cash flow, of course, would be artificially suppressed. And one thing to think about, though, is that does not necessarily mean, and this is, I think, what you were implying, that is a bad market to invest in. Lots of people invest in Los Angeles County and make money. They just make money in different ways. We did a whole video on the 4 sources of real estate investing returns, and one of them is cash flow. That's certainly important, but it's not the only way to make money in real estate. So you can watch that video up there, and you can get a better idea of some of the other ways to do it. But so the reason that most people are considering it, though, is to diversify their risk and buy cheaper property that that they can spread it over more. But there might be some reasons why not to do it, right? Like, for example, just because a property is cheaper in one place versus another does not necessarily mean it's a better market, right? So when you think about picking a market, which is really the second thing I would say people need to think about, is you have to think about like what demographics matter. Like it might be really cheap to buy in inner city XYZ city, but that doesn't necessarily mean that's the right place to be investing.
Right. The market is far more paramount than the deal itself. I mean, anybody can go out and find a cheap deal just about anywhere.
Sure,
relative.
There's probably cheap deals in LA County.
And a lot of times there's a reason why that property is cheap. And so really understanding the market makes you much more informed in terms of, how you're going to purchase and where and so forth. And so metrics drive all that stuff and demographics, right? So like in Tennessee, Southeast Tennessee, where we live, there's really good population growth trends and really good economic growth trends too. Those often go hand in hand, right? So we see prices increasing as a result of that, which is great for the value of those assets you already own. Now, there's other parts of the country, I won't mention specific markets, but where populations are in decline and people are leaving. So properties are going to be cheaper there because, well, your buyers are leaving.
This is particularly
and your renters for that matter.
particularly true in rural markets where people are moving to cities or they're moving to suburbs. But you also see that sometimes in submarkets, right? Like it could be that there's a big city like Chicago, for example, where the population of the metro area is growing, but certain submarkets in there are actually shrinking at the same time. And so it's important to think about if you're looking to invest, out of state or long distance, wherever that might be. I mean, we invest in Georgia, but I don't consider that long distance because it's like 15 minutes from here. But if you're looking to invest, say you live in New York City and you want to invest in Chattanooga, like you want to think about or anywhere in the Southeast, you want to think about like what markets make sense to invest in, and then also what type of property you're going to invest in. Because investing in Chattanooga in single-family homes might be a great option, but that doesn't necessarily mean that Chattanooga is perfect for whatever other.
And going back to it again, this is a numbers thing, right? So like population growth, which is really driven by economic growth and job growth, right?
Sure.
So you're looking for job and economic growth first in whatever markets you're researching, right? So what do those trends look like? What do they look like the last 10 years, the last 5? What are they projected to look like in those, next year, 5 years out, and so forth? And then, that's going to give you a pretty good idea. And then you also want to take a look at government, to an extent. Is it business friendly? Things of that nature.
Landlord friendly. But I would say too, another thing to keep in mind is that like a lot of this stuff is already priced in by the market. One of the reasons that some markets are more expensive than others is they're more attractive than others, right? So just because a market is expensive or cheap does not mean it's good. Just because it has good economic growth versus bad economic growth doesn't mean it's good or bad. Those trends help you, but they're not the entirety of the market. I think that one of the reasons the West Coast is more expensive is because even though it relatively lower cash flow, it tends to have more appreciation, which means people view it as safer for a long-term buy and hold. So you have to really think about what your strategy is. If you're trying to get cash flow, you might want to go to a cash flow market. If you're just trying to preserve wealth, you might look to markets where there's less cash flow, but you want to see more appreciation over time. So you really kind of have to think about what you're looking for when you're picking a market. But there are reasons to invest out of state. In fact, for Brian, when he lived in Southern California, he started investing in Chattanooga even before he was here, right?
Yeah.
And for me, I lived in Chattanooga and I started investing in Detroit. Before I invested here, I was actually investing in Michigan. And the reason the reason I decided to do that is I wanted more cash flow for one, but also because I had deeper knowledge. Even though I lived in Chattanooga, I knew more about investing in Michigan than I did here because I'm from Michigan. I had people on the ground in Michigan that I trusted. And that really brings us to the third thing you have to think about when you're going to invest out of state, and that is like, okay, if you're going to invest long distance, how are you going to build a team?
Yeah.
Because that's the real trick, right?
It's
like
critical.
Because it's one thing to say, hey, investing in Chattanooga is great, and we love investing in Chattanooga. But if you're, let's say you're on the West Coast right now and you want to invest in Chattanooga, you can't just go like throw a dart at MLS and pick the first property that comes up. You've got to figure out what properties you want. And the only way you're going to do that is if you build a team here of people that can help build that knowledge about the market for you. So what kind of people would you be looking for, Brian?
Well, I mean, in no particular order, you're going to be relying on real estate agents. You're going to be relying on contractors if you're not buying turnkey properties. You're going to need a real estate attorney that's familiar with state law and the state in which you're wanting to conduct business in. Then there's the ones maybe a little bit below that, such as, and property managers are almost at the top of that equation as well.
You're kind of biased, though.
Yeah, I am. I am.
But we did a whole episode about property management, which we can put above us here. So
then you've got, your title companies and, a host of other people.
Yeah, so the point is real estate's a team sport. So we've done previous episodes about networking and things like that. All of that stuff is going to matter. But the real thing is you've got to do two things. You have to build knowledge about the market. first you're going to do that as you decide what market to go in, and then you're going to probably have to spend some time in that market doing networking and meeting these people. I don't think it's reasonable to say I'm going to buy in Chattanooga and I'm just going to like call some people and figure it out.
That's a great point. I have talked to countless people over the years who were out-of-state investors looking to invest in Chattanooga, and I almost always start out with, well, when are you going to come down and check it out? And they're like, well, I wasn't really thinking I was going to do that. And I'm like, well, if you're going to spend tens of thousands or hundreds of thousands of capital and sign personal guarantees on debt financing with lenders, I think it makes a lot of sense to spend a couple $1,000s to spend some time in the market, and not just once. You're going to learn more on that second visit than you did on the first.
Oh yeah, and I mean,
and you don't have to spend a quarter of the year there or anything like that.
No, and in my personal experience, even being from Michigan, I still try to make 3 to 5 trips per year to see my properties in Michigan. And if I were going to invest in Iowa, I would do the same thing. I would go to Iowa, I would learn about the market, I'd meet local real estate investors, I'd go to local meetups, I'd hear what other people are doing, I would absorb as much knowledge as I could, then I'd pull the trigger on buying something, and then I would still have to go there a few times a year to make sure everything's under control, to make sure I'm maintaining those relationships. Because, you said earlier, like if you buy a turnkey property, you might not need a contractor or something. But the thing is, you're going to need to tap into a contractor resource eventually. Even a brand new property eventually is going to need somebody to fix something.
Yeah.
And, you can maybe tap into like a property manager's contractor resources or something like that, but you still have to have good property management in place. And the only way you're going to know they're good is if you're there to check up on them once in a while.
Yeah, exactly. And I think it also is worth noting that there's going to be a fair amount of trial and error with some team members, especially contractors.
Yeah, and I mean, by no means, by the way, are Brian and I experts at investing out of state. I mean, we've both done some of that. There's plenty of resources out there about this, and I would recommend some of them.
I was an out-of-state investor, and then I moved in-state.
Yes,
so.
Right. Talk about dedication, right? Like if I'm investing out of state, and I'm gonna go ahead and just move there and figure it out, right?
Yeah.
And for me, the reason I was able to invest in Michigan when I started investing in Michigan was because I had a friend and partner there that I trusted that was already doing it. If you don't have something like that, there is an argument to say maybe you shouldn't invest long distance. Like there are good deals in every market. Like maybe you just need to figure out how people are making money in your market and stick with that. But if you're going to do this, you should start by watching our show 50 or 60 times. And then after that, you should just invest in other people's deals like ours in Chattanooga. But if you're really insisting on investing in a different location, I would say, just make sure you really spend the time to learn about that market. And I think you'll be fine.
Yeah, no, couldn't agree more.
Cool. All right. Well, and that is... Cheers.